Let's discuss this further now with Chief Economist at BDO, Chen Herzog. Chen, thank you for joining me.
Hello.
Well, Chen, let's maybe break down this issue of supply and demand. It seems to fluctuate often with oil. We remember decades ago, producers, the markets were worried about peak supply. Now we're talking about peak demand as the problem. Where do you see this going?
Well, it was only 5 years ago that analysts were warning us that it's the peak oil, it's the end of oil supplies, and we are going to run out of oil. And here we are just 4 or 5 years later with low oil prices and seemingly unlimited supply. And the answer is really somewhere in the middle. Because what happened when oil prices went up, new technologies were mature for extracting oil from shale oil deposits. And actually what happened, the US has managed to double its oil production and thus increasing supply and reducing prices. So we are nowhere near a situation that there is limited oil supply, but the supply requires higher costs. So at the current oil prices of $45, $50 per barrel, those new supplies are not necessarily economic to develop.
What does this mean for the all-important OPEC meeting next week? What can we expect to be on their agenda?
Well, you know, OPEC is not as important as it used to be. And unfortunately, they lost their dominance position. Unfortunately for them, they lost their position as a dominant oil cartel. Because a cartel can only be effective if all the other players don't have the ability to increase their production. And today, the fear that OPEC players have that if they reduce their production, someone else will chip in and increase supply, the Russians, the US. So their ability as a cartel to manipulate prices is very, very ineffective. And there are weaker parties within OPEC, notably Iran and Iraq, which are concerned about reducing their quotas. They say that their production level is anyhow very low because they are just recovering from crisis or sanctions, and they don't want to be a part of this game.
Well, speaking of that volatility in oil prices, and you mentioned the U.S., we know U.S. President-elect Donald Trump has vowed to increase investment in energy production, including oil. How can we estimate that this will affect the global markets?
Well, Trump's agenda was pro-energy and anti-commitment to greenhouse gas reduction. So in a way, this could boost up consumption of conventional oil and coal rather than clean energy and gas. But if you look at the market behavior, that you will see that, for example, coal prices after Trump was elected reached a new high. So in a way, coal is becoming more and more expensive alternative to gas. So I think at the end of the day, we will use more gas, maybe not because of the environmental agenda, but because of the economic factors. So I don't see a major shift in terms of the fuel composition in the world and not in the US. And even here in Israel, we just heard this week the Ministry of Infrastructure and Energy committed to increasing the usage of gas in Israel and reducing coal.
Well, if we go back to OPEC for another moment, any move that they might try to make to raise oil prices in order to deal with the current crisis, can that be limited by the US's production potential?
Yes, the U.S. has practically unlimited production potential. We just heard of a major discovery last week of new shale oil. But most of the increased production ability is based on shale oil that is only economic in prices of $60 to $70 per barrel. At current prices, they discover the oil, but it's not worthwhile for them to develop and extract those fields. So in a way, we are below equilibrium price. At the current oil price, there is a lot of supply, but it is not materializing. We need, or the global economy needs, prices to go to between $60 to $70 per barrel to reach some kind of equilibrium where demand and supply are matched.
Certainly. It seems like a good time to go green. Chen Herzog, thank you very much for joining me for this.
Thank you.